Welcome to the Deep Dive into Finance channel, where we unravel the complexities of the financial world. Today, we're taking a closer look at a term that's often tossed around in the realm of finance and investing: due diligence. So, what is due diligence? At its core, due diligence is a comprehensive appraisal of a business or a person prior to signing a contract or an act with a certain standard of care. It's a term you'll often hear in the context of mergers and acquisitions, initial public offerings, and private equity investments. But it's not confined to these areas. In fact, it's a fundamental step in any financial decision-making process. Now let's break it down a little further. If you're considering making an investment, due diligence is your homework. It's the research you conduct to ensure the entity you're investing in is all it's claiming to be. It's your defense against investment scams and your tool for understanding the potential risks and rewards of your investment. But why is due diligence so important? Well, it's simple. It helps investors to make informed decisions. It allows you to assess the financial health of a company, understand its business model, and gauge its future prospects. It's about getting a clear picture of what you're getting into, so you can avoid unpleasant surprises down the line. Now, this doesn't mean that due diligence can guarantee success. Even the most thorough research can't predict the future, but it can significantly reduce the risk of making a poor investment decision. And in the world of finance, reducing risk is a huge part of the game. So, to sum it up, due diligence is your safety net in the financial world. It's the process of gathering and analyzing information to make an informed decision. It's about understanding the ins and outs of a potential investment and making sure you're not jumping into something you'll regret later. As we delve deeper into this topic, you'll understand why due diligence is a vital process in finance and investing. Now that you have a basic understanding of due diligence, let's explore the advantages it offers. One of the significant benefits of due diligence is risk mitigation. It's like a safety net, catching potential issues before you jump headfirst into an investment. By thoroughly examining financial statements, market trends, and legal compliance, due diligence shields you from unexpected surprises that could negatively impact your investment. It's like having a crystal ball that lets you peek into the future and protect your assets. Next, due diligence aids in informed decision-making. The process provides a wealth of information, from the company's financial health to its competitive position in the market. This knowledge empowers you to make decisions based on facts and figures, rather than relying on gut feelings or hearsay. It's like having a detailed map guiding you through the often complex world of investing. One of the most underrated benefits of due diligence is uncovering potential issues. These could be anything from legal disputes to financial discrepancies. By bringing these to light, due diligence allows you to address concerns proactively, rather than reacting when it's too late. It's like having a flashlight in a dark room, illuminating potential stumbling blocks. Finally, due diligence helps in setting realistic expectations. It provides an objective view of an investment's potential returns and risks. This clarity helps you align your investment strategy with your financial goals. It's like having a compass that keeps you on track towards your financial destination. In essence, due diligence is like a trusty guide, leading you through the investment landscape. It equips you with the tools to navigate potential pitfalls, make educated decisions, spot potential issues, and keep your expectations grounded in reality. However, as with any tool, due diligence is not a magic wand that guarantees success. It requires time, resources, and expertise to conduct effectively. It's a tool that needs to be used wisely, with a clear understanding of its limitations. Indeed, due diligence can be a powerful tool in the investor's arsenal, but it does come with its own set of challenges. While due diligence is crucial in finance and investing, it's also important to be aware of its limitations. First off, due diligence can be a time-consuming process. It demands a significant commitment of resources, both in terms of human effort and monetary expenses. For instance, it may involve going through piles of financial statements, business plans, and legal documents, as well as conducting interviews with management and employees. This can take weeks, even months, depending on the size and complexity of the investment. Then there's the potential for information overload. With the sheer amount of data available in today's digital age, it's easy to get overwhelmed. Not all information is equally valuable, and separating the wheat from the chaff can be a daunting task. It's possible to spend hours, days, or even weeks sifting through data and still miss crucial details. Moreover, due diligence isn't foolproof. In fact, there's a risk of false positives and negatives. A false positive occurs when due diligence suggests an investment is sound when it's actually risky. On the other hand, a false negative happens when due diligence deters an investor from a potentially profitable opportunity. These misjudgments can stem from a variety of factors, like inaccurate data, misinterpretation of information, or simply human error. And let's not forget the psychological aspect. The due diligence process can create a sense of false security, leading investors to believe they've eliminated all risk. However, the reality is, no amount of due diligence can predict with certainty the success or failure of an investment. Lastly, due diligence can sometimes lead to missed opportunities. While you're busy dissecting one potential investment, you might miss out on other promising opportunities. In the fast-paced world of finance and investing, timing is everything, and unfortunately, due diligence is not always a speedy process. Despite these challenges, due diligence remains a critical step in the investment process. It's about striking the right balance between thorough investigation and decisive action. After all, the goal is not to eliminate risk, but to understand and manage it effectively. Investing without due diligence is like sailing a ship without a compass. It may lead to unexpected and sometimes disastrous outcomes. Imagine you're a ship captain, setting sail on an open sea. Now, you wouldn't dream of doing so without a map, compass, or a clear understanding of the weather conditions, would you? Similarly, in the world of investing, due diligence serves as our compass, our weather forecast, our map. Due diligence is the investigation or audit of a potential investment, and it can significantly influence the success of your investment journey. It involves a thorough examination of a company's financial health, market position, and future prospects. Think of it as a health checkup for a company. Just like you wouldn't buy a house without checking its foundations, you shouldn't invest in a company without understanding its financial structure and stability. Due diligence helps investors understand a company's financial health by examining its financial statements, revenue streams, and profitability. It provides a clear picture of a company's financial performance, helping investors make informed decisions. Next, due diligence gives insight into a company's market position. This includes understanding the company's competition, market share, and industry trends. In essence, it enables you to evaluate whether the company has a strong foothold in its industry or if it's just a small fish in a big pond. Lastly, due diligence aids in assessing a company's future prospects. This involves an analysis of the company's business model, growth strategy, and the potential risks it may face in the future. Is the company poised for growth, or is it likely to stumble in the face of challenges? Due diligence, in essence, equips investors with the knowledge and understanding necessary to navigate the unpredictable waters of the investment world. It's about making informed decisions, mitigating risks, and ultimately, steering your investments towards success. Successful investing isn't just about picking winners, it's also about avoiding losers, and due diligence plays a crucial role in that. As we wrap up our deep dive into due diligence, it's clear that its benefits outweigh the challenges. We've explored the many layers of due diligence, unpacking its relevance in the world of finance and investing. Let's take a moment to summarize the key points we've discussed. In the first place, we established that due diligence is a thorough investigation or audit into a potential investment. It's a process of verification, research, and assessment that allows investors to make informed decisions. We then turned our attention to the pros of due diligence. We saw that it helps to mitigate risk by uncovering potential deal breakers, ensuring that the investment is sound and that there are no hidden liabilities or issues. Due diligence also provides a comprehensive understanding of the business, its operations, and its financial performance, which ultimately leads to more informed decision-making. However, we also highlighted the cons of due diligence. It can be a time-consuming and costly process, which might discourage some investors. Yet, we argued that this is a necessary investment of resources. The cost of not doing due diligence could be far more damaging, leading to poor investment decisions and financial loss. This led us to discuss the role of due diligence in investment success. We underscored that it's not just about ticking boxes and meeting legal requirements. Due diligence is a proactive approach to understanding the potential risks and rewards of an investment. It's a critical step in the investment process and one that can significantly impact the outcome of your investment. So, what's the takeaway here? Due diligence is an invaluable tool in the investor's toolkit. It's a process that demands time and resources, but the potential rewards are substantial. It offers a level of reassurance and confidence that cannot be underestimated. In the world of finance and investing, Due diligence isn't just an option, it's a necessity. Remember, the more you know, the less you risk.